So in this video, my plan is to cover a very different, diverse range of stocks, which I believe would be a good buying opportunity for this year. And hopefully one or two of them would resonate with your investment philosophy. And you may think that it might be a good buy for your own portfolio.
You're my ticket out of this hellhole.
As well as that, other reasons may include dividends or investing for total higher return over a very long term, or because you need to add a stock to increase diversification in the portfolio, or you think the stock is extremely cheap at the moment, or it holds some really good ESG credentials that resonates really well with you, or it could even be a speculative bet, right? So with the speculative stocks, it could be investing a small amount of money where you're okay to take that excessive amount of risk. So yes, the reason behind buying a stock is plenty. And I really wanted to make this obvious point because I'm pretty sure that there is no one out there who can come up with a definitive buy list of stocks which will be suitable for everyone out there. So just please bear that in mind when I go through my list of stocks in this video. And I will of course try to tie this back to my last video where I spoke of 3 separate bullish themes in the equity market for 2021 so that you can really understand my thought process behind why I chose these stocks. And yes, very importantly, please do your own research before you go ahead to buy any of the stocks that I've mentioned or any other stocks that you're looking at, and make sure you're really comfortable with putting your money into those companies. And anything I say in this video, they are not to be taken as any investment advice or recommendations. Hi guys, I hope you're all doing well and keeping safe and warm. The first stock in the list is Eaton. It trades on the New York Stock Exchange under the ticker ETN. It is a power management company. With the growth of renewable power and electrification of our economy, this stock could really be a clear winner within this sector. They are leading maker of electrical equipment, which accounts for about 40% of their sales. One of the reasons why this company is expected to do well is because it actually takes a lot more electrical equipment and software to bring power from the wind farm compared to your usual or traditional electrical plants. And that's exactly where this company is leading, which is this electrical equipment. Now, just to add some numbers behind this stock, the stock currently has a dividend yield of 2.5% with dividend per share of $2.80. So if you held 100 shares of this company, you can expect to get $280 in dividend income per year. In terms of valuation, its estimated 2021 PE ratio is at 23 times, and the earnings are projected to be $5 per share. Their 5 years earnings growth is currently 7.8%, and they have actually mentioned that they want to maintain that target going forward. The company has also grown their net profit margin over the last 5 years with an average return of 5.3%, and at the same time they have also grown their dividends at 7.6%. The company also has pretty good quality metrics, which I always like. They have 10% in ROE, return on equity, and 10% in net profit margin. The company also has a good debt to equity ratio and a really good overall financial strength. So I hope you can see that this company is a well-rounded, good company that operates within this sector, which is experiencing some really good tailwinds in its growth. And it's not one of the really high growth company where you're having to pay a lot more money and taking an excessive amount of risk to be able to get some of those exposure in this sector. So it ticks a lot of good boxes like ESG, valuations, and the growth sector as well. So yeah, it's a well-rounded, profitable company with really good dividends. Next on the list is Taiwan Semiconductor Manufacturing. We can invest in this Taiwanese company using the ADR line, which floats in the New York Stock Exchange under the ticker TSM. The closing price of the company was $109 end of the year, and it has a market value of $475 billion. So it's a very large cap company. This is a very popular company in many of the active EM funds that I have seen. The company was established in 1987. It was the world's first largest dedicated semiconductor factory. For those who may not know, semiconductor is a chemical element or a compound that conducts electricity under certain circumstances and not the others. So it is a great medium for controlling current or electricity. So I hope you can imagine that it is actually a very essential component within a lot of electronic circuits. In terms of product, the company designs and manufactures a lot of chips for the likes of big companies like Apple. So Apple is actually their largest customer. Other customers include Nvidia and AMD. And although it is an emerging market company, it is actually one of the very reliable and trusted companies out there, and it fares very well under ESG as well. So if I look into some of the numbers, it's got a dividend yield of 1.7% and it pays out $1.70 per share. Its 2021 estimated PE ratio is at 25 times. The company has also grown its earnings over the last 3 years at 5.5% and last year at 49%. The company also fares very well under quality metrics that I also look out for. So it's got a really good mid-20s in ROE and mid-30s in net profit margin. It also has very low debt as well, so it's got a good debt to equity ratio. The reason why this company is on my list again is to do with the industry tailwind. So trends highlight that more and more companies are in fact outsourcing their chip production, and this company is well placed as a leader to capture that growth. So it ticks 3 really important boxes for me. It's got that ESG characteristic, it's got EM exposure, specifically Asia, and it's operating within a tailwind growth sector. Next stock is Newmont Mining under the ticker symbol NEM. Again, it trades under the New York Stock Exchange, and the ending share price of this company was $60 per share. The company basically works in exploration and production of gold and other precious metal. Although the current share price is around $60, the average analyst price target for this company is at $80. So you can hope to get about 35% upside by investing in this company. If I look into some of the numbers, it's got a dividend yield of 2.7%, estimated PE of 15 times, so it looks pretty good. It does not look expensive, it's actually quite reasonable. It's got an EPS, so earnings per share, at $4.15, estimated over this year. Its earnings growth has been pretty good, actually 25% over last 3 years, and it has also grown its net profit margin by 27%. So it's overall a pretty good quality company. Talking of quality, it's got an ROE of 18% and 11% in ROI, so return on investment. As I've mentioned, not only was it growing its profitability margins, it's actually really profitable on its own. So the current figure on its net profit margin is 30%. Although the 30% number is very good over the last 12 months, the industry that the company operates in, which is commodities, is actually quite volatile, so it fluctuates quite a lot, especially with the business cycle. So the current profitability number may not reflect year on year. You can see that when you look at their average 5 years profitability number, which is actually 8%. So yeah, it's not as high as 30%. So that's something to bear in mind. The company also have very good leverage numbers as well. So the debt to equity ratio is quite reasonable, and they also have an overall good financial strength in terms of balance sheet. The reason why I am adding this in the list is again to do with the economic rationale that I spoke about in my last video. Although the vaccine optimism have increased investor confidence and as a result have also increased the risk tolerance level of investors, I do however think that it could be quite short-lived, because the underlying economic fundamentals have not actually changed for the long term. So the real interest rate in our economy, when you take into account inflation, it is still below 0, while the dollar is remaining weak. And there is generally an inverse relationship between a weak dollar and some of these commodities. So my thinking is that the ongoing monetary and fiscal stimulus, it is likely to continue for a while, and that should really benefit this industry. Gold has, always been a really good hedge against inflation. However, rather than buying actual gold, I prefer to invest in gold mining companies, because gold, when you buy it, it doesn't really give you anything except that little capital appreciation. It doesn't have any yield. You can't get any income out of it, and yeah, it's just a good hedge overall. But if you do buy companies that are working within the gold commodity industry, you can at least hope to get that overall good shareholder return, while at the same time having correlation to the underlying commodity, which is gold. The next company I want to talk about is Apple. I don't think that company needs any extra introduction. It trades under the ticker AAPL, and its closing price last year was $132. It is a tech company, and it has a current market value of 2 trillion. I have actually covered Apple, the reason behind why I hold Apple, in one of my previous video where I talk about my current high growth trading 212 invest account. So do feel free to check that one out after you watch this video. So this company is very much loved by Wall Street analysts, and its current price target can range between $120 to $150, depends on which analyst you speak to. Apple has current dividend yield of 0.7%, and its estimated PE ratio looks 32 times. So you're paying 32 times per unit of earnings that this company makes. It's a very profitable and extremely high quality business. It's got 50% 5 years average ROE ratio and 22% average ROI. Return on investment. Its average 5 years net profit margin is 22%. It's a very profitable company. It's already a really massive company, like $2 trillion market value, but the company is still giving the investors plenty of reasons to believe that it can grow even more. And Apple is doing this by boosting their product cycle on an ongoing basis. They have already mentioned that they will increase their phone production by 30% over the first half of this year, and their new M1 processors have re-energized the MacBook laptop market, which is set to do well as we see an increase in home working trend. They are a tech company that is committed to increase their dividends, so they have already started off with a very low dividend payout ratio, which can help out to compound our investment over time. And most recently, they have mentioned the introduction of Apple Car, which Elon Musk see as their direct competition for Tesla. So knowing Apple, I think we can really rely on their quality and their design. They are very innovative, they have sleek design, and they have a huge customer base and loyalty. So when they do launch their Apple Car, we can be sure that it is likely to take off and be well received by their customer. So yes, it's giving investors plenty of reasons to invest and carry on investing in this company for at least the next 10 years. Next on my list is Bank of America under the ticker symbol BAC. Again, trades in the New York Stock Exchange. The closing price of this company was $30, and its market value is at $216 billion. It's a financial company, it's a bank, so again, I don't think it needs a lot of introduction as to what they do. I should add that a lot of investors and people in general, they have lost interest in a lot of banks, especially after the global financial crisis. However, banks have actually improved quite a lot over last year, and today's banks are healthier than they have ever been. Although COVID was supposed to have a really bad impact on banks, it did not hurt them as much because of the support that the banks were getting from the Federal Reserve. And so the banks' share, especially BACs, have been rallying right after March, when we started to see some positive recovery from the COVID crash. However, they still remain within their 2017 level in terms of price. And as I've mentioned in my last video, the stock market, it is really craving for some value. It is about time, and a lot of investors are putting their money in thinking that value investing will come back. And when it does come back, sectors like financials, they are the first to really take on that benefit. And so if we do see that rally back, so Bank of America is actually one of the largest banks in the world, and it is well set to capitalize on that rally. In terms of numbers, it's got a dividend yield of 2.9% with dividend per share of 0.72 cents. So their estimated PB ratio is at 1 for the year, and banks have already remained pretty cheap over the last few years, and so valuation is actually not a worry when it comes to this sector or this company. In terms of some of the growth numbers, its 3 years earnings growth was 45%, which is extremely good. They also have 5.3% growth in their book value over 5-year period as well, and 36% growth in their net profit margin over the same time period. Their last trailing 12 months profit was at 23% net profit, and their ROE is at 10%. So the reason why I have this stock in my list, as I've mentioned, is to do with the value rally. When the economy starts to recover after COVID and central banks around the world starts to raise interest rates, which are good for bank, these companies are likely to do very well. So having some sort of financial exposure is a good level of diversification for any portfolio. And Bank of America is one of the largest to kind of win in that situation. Next in my list is Essential Utilities, under the ticker symbol WTRG. Its closing price was $47. It's an utility water company and has a market value of $11.1 billion. Did you know that we can survive without food for 3 weeks, but without water for less than 3 days? While water is something that we tend to take for granted, there are still 30 million Americans who live in areas within the states where the water facility violates the standards set by EPA. Not investment related, but if you haven't watched the movie Dark Waters, I highly recommend it. It's a really good movie based on true events around water contamination and its impact on health. So back to the stock. Essential Utilities, they provide water and wastewater service in parts of the state. So this is a very defensive company since it operates within this water or utility sector, and it has a lot of good ESG credentials as well. Analysts expect the price to reach about $55, so giving you about 17 to 20% upside in this company. In terms of dividends, it pays about 2.2% dividend yield with dividend per share of 97 cents. Its estimated PE ratio this year is 28 times. The company is making earnings per share at $1.58 this year, which is expected to increase to 1.68 next year and 1.78 in the year after. Over the last year, it grew its earning by 56%. Its annual earnings and revenue is also expected to grow at a 2-digit number in the coming years, which is well above their industry average. In terms of quality metrics, it's got an ROE of 6% and 20% in net profit margin over the last 12 months trading. Why do I have this in my list? As I've mentioned, we are, taking water for granted, but the numbers show that water is turning into a precious commodity. Just over a month ago, water futures started to trade in the Wall Street. The state of California is actually worried about safer water availability in the coming years. This defensive company can be a great diversification, and it also comes with really good ESG metrics as well. So by next year, the company plans to purchase 68% of its energy from renewable sources and will thereby meet the Paris Accord nearly 8 years earlier. Although it's a defensive company, the company have actually returned their shareholder a number much higher than S&P 500 over the last 5 years. So you don't really have to give up a lot of upside by investing in this defensive company. Next on my list is an energy company. It's an alternative energy company and it's called Orsted. It's under the ticker symbol ORHE. It's a Danish company and it closed at $204 last year. The market value of the company is at 82 billion. And if you really want to invest your money to make a positive change in this world, then you do have to go a little bit above your normal ESG fund. The most powerful type of ESG investing is actually called impact investing. And this company sits perfectly under this umbrella. They are the world's biggest developer of offshore wind farm, and this company wants to create a world that runs entirely on green energy. They are helping other companies to achieve their own renewable energy target. For example, Amazon signed a 10-year contract with them. They are helping Amazon reach their 100% renewable energy target by 2030 and net zero carbon by 2040. It has a dividend yield of 2%, and in terms of valuation, the estimated PE ratio is at 53 times. So yes, it is actually currently a lot expensive, and that's because the stock has rallied really strongly over the last few months. So timing wise, it may not be the price to get into this stock, but it is something to definitely keep in watch. So when the price does correct, we are all ready to invest in this great company. In terms of growth, it has a 5 years earnings growth of 23%, which is a lot higher compared to the industry and the market. And quality metrics, it's got an ROE of 18% and nearly 30% in net profit margin. So there is an obvious reason behind why I've included this stock. It's really well positioned to tap into that long-term growth in renewables. The company remains a unique leader within the offshore wind energy segment and has first mover advantage when it comes to some of those technological innovation. The company has ambition to increase their dividend at a higher one-digit number and deliver long-term return on capital employed at 10% and drive annual operating profit growth at 20%. So they are setting some really good direction within the financial numbers to make it a worthwhile investing case. And finally, I wanted to end with a UK small cap company called Hollywood Bowl under the ticker symbol BOWL. The stock's closing price was just under £2 per share, and the market value is 215 million. So it's a very small company. So this company is definitely a speculative bet at the moment. It is suitable for someone who is able to take excessive amount of risk in their COVID recovery play. Hollywood Bowl, as the name suggests, is one of UK's 10-pin bowling alley, and they operate 1/4 of all the bowling alley in the UK. Since it is a leisure stock, it was awfully bitten by COVID. However, its long-term numbers look quite robust. Last month, the company reported very strong customer demand and better than expected performance when they reopened right after the first lockdown. So with this company, we'll have to kind of wait and see when the current lockdown lifts and how well they do and whether the demand continues to come in. So in terms of numbers, the current dividend yield is at 0.3%, which is expected to grow to 1.6% in the coming year. In terms of valuation, its current estimated earnings ratio is at 33 times, which is expected to fall to 15 times in the year 2022. Looking at growth numbers at the moment will obviously be a little misleading. So let's look at some of the forecast growth numbers. Its current earnings per share is about 2p per share for this year. However, analysts estimate that the number can grow to 8p per share over this year and then 19p per share in the year after. In terms of percentage, this is a very strong 300% increase in expected profitability this year. In terms of quality, the company is a small cap company, so it's important to look at some of their working capital number. So they do have a positive working capital number, which is important because you do want them to be able to carry on in the business over the short term. If the situation does not improve. Their pre-COVID ROE was at 20 times and the net profit margin at 15 times. So hopefully as the rebound happens and the demand comes in, they can get back to that number in the near future. So why do I have it? As I've mentioned, it's a very speculative buy. So it can either do really well or not do very well. So it's all driven by what happens with this lockdown and whether the demand from customer comes back. However, if I want to speculate on some of the COVID recovery stocks, then I would much rather invest in some of these leisure stocks than some of the, airline stocks, which has huge amount of debt, a lot of high fixed costs, and usually have a very hard time being profitable. So this company can be a good contrarian value play in, any of our portfolio. So yep, these are all the stocks I wanted to talk about in this video. Let me know if you're thinking of investing in any of these companies or if you already hold them in your portfolio. If I haven't mentioned one of the stocks you thought would be great this year, do also comment it below and let me know. I'd love to check it out. And until next time, look after yourself and your money.